Now there's another tax that you get to pay. They call it self-employment tax.
Self-employment tax.
As a proprietorship, you get the lovely joy of paying both sides of that.
That's right.
So it's 15.3%. That starts to be expensive.
Welcome to Beacon for Business, the podcast that illuminates the path to clear, structured financial systems for established CEOs, entrepreneurs, and startups. I'm Brett Spencer, owner of Spencer Business Advisory. I help companies strengthen their financial health and streamline operations. Today, I'm speaking with Tom South. Tom is a graduate from the University of Idaho and has been a CPA in Boise since 1982, working for 2 local CPA firms before starting and managing his own firm for 31 years. Tom was liquidated from his firm at the end of 2018 when he turned 62 and began South Litigation Consulting, LLC, in 2019, where he provides financial expert witness services for financial damages and forensic services for legal court cases. Welcome to Beacon for Business, Tom.
Thanks, Brett. Glad to be here with you.
So Tom, you and I have been accountants for a few years, probably more than either one of us want to. Well, I guess I've already talked about how many years you've been in. I've spent my career in the corporate world where you've been in the CPA world. What very basic advice can you give an entrepreneur who is considering starting their own business that may save them time and money down the road?
Well, the first advice I always gave my clients, they'd come in a zillion times. I would have clients that would come in and say, I'm thinking about starting a business. And I made it a point to tell them that the most important thing that you can do, you've got an idea, okay? But I'm going to tell you the most important thing you can do is have good record keeping, okay? I can't stress that enough. Good records pay for themselves, and you cannot be successful without having good records, good record keeping, good books. The first thing you need to do is make sure that you have a separate checking account for the business. Okay, you need to separate all transactions that are related to the business need to be ran through a separate checking account. So when you go to the bank and you tell them that you want to you're going to start a business and you want to open up a checking account, there's 2 things they need, okay? First thing they need is they need a certificate of registration. So the first thing you need to do is go on to the Secretary of State's website. You can file for an LLC, you can file for a fictitious DBA, doing business as. But the bank will require that in order to open a checking account in the name of a business. They will require that you provide them with a certificate of business that you can get from the Secretary of State.
And that's because it needs to be its own legal entity, correct? It's separate from Tom South, the person.
Correct. Yeah, you're creating a separate entity. Okay, need separate books and accounts. And part of that is opening a checking account to capture all the activity, both money coming in and money going out. And then with most businesses, it's a lot of outgo before the inco. So, but you want to track all that because even if you operate your business at a loss for the first year, you can carry those losses forward. Okay, the tax impact of your business becomes very important. And I always told my clients, when you start a business, when you have to get in the mentality, when you write a check, you're paying for something, you're buying something for your business. If it's related to the business, pay for it through the business checking account. Even if it's cash, if you're paying for something in cash, if it's for the business, keep the receipt. Okay, there's a way to enter that into the books. And when I started in accounting, QuickBooks wasn't even around. I know that sounds really strange to some people, but...
Well, I dare say desktops were a new thing in those days.
Yeah, yep. The early 80s, I think I bought my first PC in probably 82, 83, somewhere in there. And it was. I think I had my first PC before there was an internet.
Yep. Well, there was an internet. We just didn't know about it. It was a secret thing.
One of those things. So um, there was a company in Boise, Idaho, by the name of Cougar Mountain Software. Does that
Yep.
ring
I
a bell?
remember them.
They had a very sophisticated accounting system, all the modules, payable, inventory. It was a very decent system. The only challenge was you pretty much needed to be an accountant to understand how to use the software. I mean, it was not friendly user like QuickBooks is. QuickBooks was the one that everybody's familiar with today, and probably by far is still the most popular. And it's inexpensive. It used to be really inexpensive back when you could spend $199 and get the desk book version where you
Yeah.
loaded it on local computer, and it worked great. Well,
And my own 2 cents from very recent experiences like yesterday. Um, the desktop is still a little more full featured than QuickBooks Online. Online will do most everything, but the desktop is still just a little bit better. I know that Intuit is trying to push people towards that cloud, but yeah, it's
it's all
money.
money. Yes, because
So
when you do
you,
cloud, you pay a monthly subscription.
I want to back up just a little bit. You made a comment. Um, you get your checking account, you get your credit card, and you start buying things. You buy product, you buy office supplies, different things, and you made a comment about keeping your receipts. One of the things I run into these days, everything's online, everything is in the computer. Um, what I
Automation.
what I run into with my clients sometimes is I enter it in and then I throw the receipt away, and that's that that can lead to problems. And I know that years ago, I think it's still the case. If you if you scan it into your system and you have your original documentation, the original invoices, sales invoices, different things, and if you, I think the rule of thumb is if you keep the paper document, that is still the legal document. If you scan it in and keep the legal document, the 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 paper document is still a legal document. But once it's scanned in, you can destroy the paper document at that point.
Are you rendering legal advice now?
No, I guess the point is you need to keep your backup documentation.
You're spot on again. Yes, you need to keep that. And I told people go, well, geez, it's the challenge in conveying to the client what they need to do. It's so simple to us and you and me because we we we're accountants, for crying out loud.
It's
That's
muscle
what we do.
memory after all these years.
It is, but it's pretty simple. I said, the first thing you need to do when you set up QuickBooks is it's going to ask you for a chart of accounts.
Yeah. What's that?
And I used to tell, yeah, what's chart of accounts? I said, well, that's how you're going to classify your expenditures, okay? And then they say, well, what do I use for classification? I said, get on the internet, go to the IRS website, print out a Schedule C, okay? A Schedule C for the 1040 is income from proprietorship.
Yeah. Sole
I think
proprietorship.
yeah, sole proprietorship. That's what a sole proprietorship, and that is a lot of times for individuals. It's a different discussion if you've got more than one person that's coming in with that idea. But if for most people to start out, because the other thing that we tried to do is keep it as simple as possible. And the only thing that drives complexity is profit. Okay. Because what happens when you throw profit into the mixture? You've got income taxes. Now we're talking a substantial cost to the business. Okay. Are there ways to complicate and sophisticate that business down the road if the profitability is going to be there? You bet there is. And we're going to be talking about them all along through the evolution of your business. But
Absolutely.
let's keep it simple from the start. So print out the Schedule C from the IRS website, repairs, utilities. It's got all the classifications. That's our chart of accounts. That's how we're going to classify. Because every time you write a check, guess what you got to do? You got to give it a code.
So one of the reasons why I saw the value of bringing Tom on, he's been a CPA his whole career. He's seen business through many lenses, but a lot of it has been through tax preparation, where my career has been in the corporate world. And so I'll add a little bit to what you just said. From your perspective, you want clean books so you can prepare accurate um, tax statements, tax returns that you can put your signature on. From a corporate perspective, I want books that tell me a story. I want books that tell me how the company's doing and where we're spending money and where we're profitable and where we're not profitable. And so as I totally agree with you. The way to start off with your chart of accounts is exactly what you said. And it's a very basic and it's simple. Um, but then some of the complexity, as you say, it comes with profit, but managing the profit is you need to get information to manage that. And what is it that you had 20% growth in sales last year and you did 5 different things. So do you know where the growth came from? Do you know what to repeat and what not to repeat type of thing? So we're saying the same thing, only looking at things from a little bit different lens.
Yeah, no, I would agree with that. Yeah, that's a good analogy. And my philosophy was always that the tax ramifications are a secondary product.
And that's
My emphasis on financial statements and having good financial statements and good records is how the hell can you make good decisions if you don't know where you're at and where you're going?
absolutely.
It's it's not rocket science. I mean, as you get it, and I will tell you that and we can talk about some of those tax implications, some of the tax history, and where to go with those businesses, um, and that. But the foundation is you've got to have good record keeping because you've got to make as your business starts and it starts, and it's when it starts to take off, you're faced with a, a zillion questions and a zillion decisions because you're making money. And, I had a very wise old client of mine tell me one time that profitability is addictive.
So one of the plugs that I'll give the CPA firms right now, I've never worked in a CPA firm. I chose a different route. But what you're paying a CPA firm to do is to stay current for the continuing education that they do to stay current on tax code. And the tax code is a beast. And there's so many different things you have to know. And if you're going to do a good job with your client, you don't want to practice tax evasion, but you know, tax avoidance is legal. So, you want to do the best thing. So what you're paying for that CPA is well worth it because you're paying them to stay up on the tax code, get that continuing education, and be the expert, be the subject matter expert for taxes.
Well, that's a good plug for CPA firms, and being that that was my livelihood for 40 plus years, I appreciate that plug and that compliment. Um, yes, it's part of the equation of a successful business entity. And when you start a business and you start having profits, can we complicate that business from a tax standpoint? You bet we can. And it's fun to do. My people used to ask me, Tom, who's your favorite clients? And, I'd look around, make sure nobody had a gun or a stick or a bat. And I'd say people that are passionate about what they do and want to make money. And when you run into those people, they are a blast to work with.
There's there's
You know,
a there's a there's something that runs through the veins of entrepreneurs, and they're kind of natural risk takers. And they one of the most amazing things, one of the first client I ever had when I started my fractional CFO work, I had a young man who wanted to buy a auto body shop, local auto body shop, and he ran into 3 or 4 roadblocks that would have derailed and stopped anybody else, but he just simply would not say no. And he found a way through everything. And he ended up having a, pretty successful business, and went on and sold that, built it up, sold that, and went and started a different one. Yeah. I think they call that serial entrepreneurs.
no, repeat offenders.
Yeah. Repeat offenders.
The one thing that every successful business person has ever had that I've dealt with is good records and good financial statements. And here's the common thing that happens. And another good reason for good financial statements, okay? What happens when you start, let's say you start this business and it takes off, and what's the first thing that happens to a growing business? I got income on my financial statement. I got no dinero. I got no
I
cash.
got profit, but no cash.
Yeah. I would tell my clients, I'd have clients, even existing clients, that would come in and say, "Hey, I need to put some projections together. I need to go borrow some money at the bank, something like that." And the one thing that I would tell them, and the one thing that I lived by my entire career and still to this day, growth requires a tremendous amount of working capital.
Yes, absolutely.
What's working capital? Well, the definition of working capital is the quick ratio, which is the current assets less the current liabilities, right? That if you pick up the accounting textbook, that's what it tells you. Working capital. It takes growth. If I was doing my job, I was sitting down with my client who had a business that was doing very well, and I could see that coming, and I would say, "Okay, do you have a good banking relationship?" "No, I don't have a relationship." "Well, you need one, because you're going to need, and then you're going to have to provide working capital for the growth of your company."
And with that, you've got to be able to provide financial statements showing where you're at, a snapshot of where your company is right now.
And where you're going.
If you're profitable or not, what your liabilities are, what your assets are, what your equity is. And that's when I get a lot of calls is I need to get a line of credit for my business. I guess some of the banks now are giving loans, working capital loans based on bank statements alone.
Interesting.
You're going to have to be able to provide some interim financial statements that they're going to ask for your last year's tax returns, because that's kind of what's set in stone. That's what you told IRS your operations were for the year before, and so you've got to have the capability of providing those. And again, your first point is so spot on. You've got to have good records, and you got to have somebody that is capable of putting that together for the bank.
Yes, the tax returns are critical for banking relationship, financial statements, and a lot of times if you've got a growing business, we used to do a lot of, some will refer to it as uh, uh, projections. Some will refer to it as forecast, budget, whatever. It's basically looking at the next 12 months, the next 5 years. That vision is very strong and really real to them.
Yes, they know where they
Very
want to
well.
be. They just
Yes.
sometimes they just don't quite know how to get there, like all of us. Um, But I break it down to, you start off with a planning session, call it a strategic planning session, call it a planning session. You come up with a 30,000-foot view of where you are and where you want to go. You need to know where
Well,
you're at.
I can tell a lot. I can look at a tax return and I always love telling my clients, you have to remember that a tax return to a CPA is like a Bible to a preacher.
Or a roadmap. It tells, financial statements tell a story, especially if you know that they're accurate. Even if they're not accurate, it tells a story that you've got some problems of why they're not accurate. But it tells a story, and it's a skill that you and I have worked with for 40 years. But it's a skill that you learn how to use. You learn how to see what it is that the story is telling you.
And a lot of my time was spent with my clients teaching them how to read their financial statements, what they mean. What's an inventory turn? What's an inventory turn? Well, if you're dealing with inventory and you don't know what inventory turn is, you're in the wrong business.
Exactly. And compare your inventory level in
Oh,
October
inventory.
to your inventory level of October of last year, and what's happened, or the inventory at the beginning of the year. What's happened is and especially if you're saying I'm profitable but I don't have any cash, I'm cash poor. Maybe it's all in your inventory.
Yes. And yeah, and those businesses that started out that did well, they have those challenges. They face those things on a daily basis. And that's what the CPA is there for, is to help you understand your business. And by all means, the most important thing is to help educate the client so they can make better. The only good decision is one that's well informed.
Exactly. I had a client a few years ago. Company had been around for a long time, really high quality products that they produced, and they hadn't been profitable for a while. And I got lucky. I went in and I found the problem right away. And it was during COVID, when prices were going through the roof and their cost of production was through the roof. So we were able to make some adjustments, and they went from a 6-figure loss to a 6-figure net income. And the one of the management people, well, now we got to pay taxes. I said, well, so that's kind of, if you don't have to pay taxes, you either are really good at tax um, avoidance, or you don't have profit. So
That's true. And I always told my clients, let's get something on the table and make a big distinction right up front. Okay. There's two ways that you don't pay tax. There's tax avoidance. By definition, tax avoidance is working within the law to minimize your taxes.
exactly,
Total legal.
using the tax code to your benefit
Yeah.
legally.
Yes. That comes in the form of structure, how you're operating your business. It's set and it just multiplies from there. Okay. So what's the other way you don't pay tax? That's called tax evasion. And I told them, if you want to know what tax evasion is, call Willie Nelson.
Yeah.
He'll tell you what evasion is. I
So,
saw Willie in an interview one time, and he said the only guy he knew that was better at cheating on his taxes than him was Wesley Snipes.
well, it seems to me like Wesley Snipes had free room and board from the state for a while. So,
Yeah. Well, that's what tax evasion will get you.
yeah.
That's a felony offense, and that puts you behind bars.
So, one of the issues that I see with small businesses, small entrepreneurs, they put a lot of cash in. They get a lot of working capital. They either put their own cash in, or they find a source to loan them the money, or a partner that will pony up some cash. But then they kind of use their company as an ATM, and there's some pitfalls to that. Um, Number one, you're damaging the amount of working capital that you have. But there's some other legal issues. You want to, when you have we'll talk a little bit about corporate structure, but when you have an entity that is, we talked about separate legal entities, and the company is a separate legal entity, but then when you cross that barrier and start treating it like your personal piggy bank, talk about some of the pitfalls you can have with that.
Well, you've already addressed it, and that is the biggest pitfall is cash flow. I mean, if they don't have any discipline and they like to spend a lot of money, especially on themselves, which that's not uncommon. I mean, you see that a lot. I mean, why do people work? To enjoy what they receive for their compensation, right? And who better to spend the money on than moi? But it's speaking about, you start a business and it's very profitable, and how do you migrate that business to the next level as far as entity choice? I will tell you that the 90% of our corporate clients in our practice were S corporations. Okay. And a lot of times when my clients came in and want to start a business, I said, okay, here's how we're going to do. I told them how to get the certificate of business, EIN number. They went to the bank, they opened an account. They're running 2 years later and they're making lots of money. I said, okay, now we need to start to talk about changing this structure.
So
Okay.
what would they usually start out as, a sole proprietor, or would they go to do an LLC?
9 times out of 10. Well, when I started, LLCs were, I'm not sure LLCs were even around in 1980. It was the early 80s when they started to gain popularity.
Yeah. There's been some rule changes that have made them and S corps more popular.
Yes, but remember, the history is LLCs have, they were in the European countries centuries ago. Not a lot of people do proprietorships these days because of the LLC. They do a proprietorship, but they do it in the form of the LLC.
So what's
I
the
don't.
purpose of wanting to have an entity like that between an LLC and a corporation? You know,
The LLC does protect your personal assets.
it puts a wall between your company and your personal assets. So
If you're going to do a proprietorship, why not do it as an LLC? It at least separates your exposure for personal liability to your personal assets. Okay. With LLC, they can look strictly to the business for satisfaction of any claims and things of that nature.
you have a little bit more regulatory and administrative burden when you do a corporation, whether it's a C corporation or an S corporation. LLCs don't have quite as much.
Right. And keep in mind again, a corporation is a corporation. If you elect to be an S corporation, all you do to do that is you file, I think it's Form 2553 with the IRS that says, hey, IRS, I want to be taxed as an S corporation rather than a regular corporation.
So
Yes.
why an S corporation versus a C corporation?
I always, this is just my personal opinion. I always think to get to the root of the answer, you got to go to the history. History tells everything. Okay. Back in the early 80s, uh, we used to have what was called the genuine utilities doctrine. It was a tax provision that basically said you start out as a corporation. Okay. So you set up a corporation. It's a separate legal entity. Just like Boeing. Okay. Boeing is a C corporation. Okay. Brett Spencer, Yuck Yuck Cells Inc. wants to be a corporation. You go to the attorney, you have them file articles of incorporation with the Secretary of State in your state. You get your certificate, you go to the bank, you get your EIN, you go to the bank, you've got a corporate checking account. You're in business, you're a corporation. Okay. And you're off and running. Brett Spencer Yuck 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 Inc. runs 10 years as a C corporation. It's got $1 million left in the bank when he decides it's time to go out and count fence posts for the rest of my days, that productive days. That's all I want to do. I'm done. I want to close down this corporation. Under today's scenario, you pay tax on all that $1 million. Back under the general utilities doctrine, there was beneficial saying, yeah, it's not fair to have double taxation. So we're going to give you beneficial treatment so you don't have to pay tax on all that $1 million that you accumulated in your corporation. Well, I'm going to guess 84, 83, 84, somewhere in there, they repealed the general utilities doctrine. Now that didn't mean squat to anybody except tax CPAs. Yeah. Well, that's where S corporations got so damn popular. So how do you surround that double?
Whenever Congress is talking about changing the tax code and maybe giving tax breaks, they talk about the double taxation of corporations, and that's the C corporation, because the C corporation, it files its own return, and then if you want to take money out of it as an owner or a shareholder of that corporation, you have to do a dividend, and then the dividend gets taxed as well. So the corporation
Double
gets
tax.
taxed, and then the shareholder gets taxed for any money that they take out.
You're absolutely right. So that's where S corporations that's where they first became popular. Okay. Is because when they repealed the general utilities doctrine, well, and this is a subject for another, I'm not trying to sell myself on coming back for another session, but there's another whole session on how complex it is to take a regular corporation to an S corporation.
Yes. And I've actually gone through that. They made changes in the 90s that made it more attractive to, and then the taxation issues that are favorable for S corporations, it made it very attractive for companies to change from C status to S status. And that's a whole nother process. You've got to do evaluation, and that's more of an I think that's more of an economics process than it is an accounting process, or maybe a hybrid.
Yep. Nope. You're absolutely right. Now, let me tell you why S corporations are really, really popular today and have been. Now, there's another tax that you get to pay. They call it self-employment tax.
Self-employment tax.
What is it? It's a fancy name for Social Security tax. Because
so you can't, even if you're not an employee, you still have to pay it. But
it's called employment.
Not only do you get to pay it, you get to pay both sides of it. Or if you're an employee, you pay your portion of it, and your employer pays the other portion of it, the other half of it. But if you have your own corporation or LLC or whatever, you get to pay both sides of it.
As a proprietorship, you get the lovely joy of paying both sides of that.
That's right.
So it's 15.3%. That's, that starts to be expensive. In order to save tax, sometimes you have to take additional steps. So putting yourself on the payroll is how you get around that. Do we pay her at the $100,000 in salary? Well, only if we want to pay $15,000 in Social Security tax. So every time I would take Sally and put her in an S corporation, the first question out of her mind is, well, why do I have to pay myself a payroll? Well, that's a good question. And interesting enough, there was a law firm in Rexburg, Idaho. Okay. Rexburg is not a big city. Last time I was there, it's not a very big city. But this law firm in Rexburg, Idaho decided they were really good with tax advice. They figured that if they could convert their law practice to an S corporation, they could pay themselves 100% dividends, and they wouldn't have to pay any Social Security tax. Do you know how many break room reader board their article was posted on around the country,
I'll bet.
they got nailed by the IRS. Reasonable compensation.
Yes.
That was how IRS fights that. You don't even have to wait to be audited. If you have an S corporation and you pay yourself 100% of dividends and there's no number on officer compensation, you don't even get audited. You just get a bill from the IRS. That's how easy they make it for you.
Yes.
You can't do that.
No.
Okay.
What I've dealt with in the past was a company that I actually came in as their first controller, and they had the owners or officers, obviously, they had paid themselves a reasonable wage, but then they were also paying themselves management consulting fees. And so IRS took the position that that should have been income and levied a healthy fine, an assessment for that. Now, that took years to resolve, and it kind of ended up with a mixed result. But that's kind of walking a little too close to the fire sometimes when you do things a little too creatively. So let's talk a little bit about mechanics. When it comes down to filing taxes or paying taxes or paying your estimates, quarterly estimates, a sole proprietor versus an LLC versus a C corporation versus an S corporation. So sole proprietor, basically, you're filing a Schedule C on your personal return, correct?
Yes.
And so, and then if you have enough income, if you have enough profit, you probably should be doing some estimates during the year.
Correct.
Okay. And
Well,
now,
here's the law.
okay.
Well, the law says that you have to pay 90% of your tax in equally over the year.
Yes.
If you don't do that, then when you go on to QuickBooks to do your tax return, into it to do TurboTax, do your taxes, it's going to figure a penalty.
Yes.
It's going to fill out the form 2210, and it's going to, and the penalty. What is it? It's an interest factor. Okay, they never called it interest because in the old days, and now under the new bill, remember in the old days, you used to be able to deduct 100% of your interest. Didn't matter whether you were paying your grandma or who, you got to deduct all your interest. Now, and that went away. And now there's a new provision in the big beautiful bill that allows you to deduct cars interest paid on auto loans if they're built in the US. So that's the first step back in that. But it's interest. And why did the IRS not call it interest? Because interest used to be deductible. Penalties are never deductible. Never, 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 never. So that's why they do that. So yes, you have to, but in wrapping it up, let's just say that is a good reason. I'm going to plug CPAs here. That's why you need a good relationship with a CPA. My
Absolutely.
client knew where they stood year round. That's how you plan for taxes. You know what your liability is, when you have to write the check, and you know what that is on an ongoing basis, and that's how you plan accordingly.
So I want to get to the difference of that, of like a C corporation tax, how you handle that tax return and payment of those taxes versus an LLC that elects an S corporation taxation, or a corporation that elects an S corporation. A C corporation, they have their own separate tax return for a C corporation, and they pay the tax. It's different for an S corporation or an LLC, correct?
Correct. An S corporation is what's referred to as same as a partnership. It's referred to as a flow through. S corporations don't pay tax, generally speaking. That income flows through to the individual return. You report it on your 1040, and you pay the tax on it there.
So it flows. It's a flow through tax. It flows through to the members, the owners of the entity. And
Yes,
the company actually, you calculate what the estimates are going to be, or what the year end tax is going to be, and then the company actually cuts a check to the owner, and then the owner pays the taxes. So it flows through, and it gets rid of that double taxation.
that's correct. Yeah, in 19 in uh, probably 19 early 90s, the Internal Revenue Service published a survey that they hired a consulting firm, paid them $2 million. They wanted to find out if there was a direct correlation between the increase in the number of S corporation elections to the decrease in the amount of money going into the Social Security fund. They paid a consulting firm $2 million. I would have given them my answer for $2,000, and I would have said, duh, are you stupid? Yeah,
Like I said, I went through it. The company I was with had been in business for maybe 14, 15 years, had some accumulated earnings, and went from C structure to an S structure. And it was an expensive endeavor, but it was worth it. I mean, we saved a lot of money on taxes, and it helped the owners. There were two owners, and it was a good move. But you have to do it right. You have to do evaluation, and um, you have to dot all the I's and cross all the T's.
good advice. And you're absolutely right. Take it, taking a C corporation to an S corporation, it can be done, but it needs to be, you need to know what you're doing or you're going to get your ass handed to you.
So the other thing, there's a thing called a corporate veil, and I guess it probably applies to an LLC too, to some degree. But so the activities of the company don't, there's a barrier for anyone who challenges what you've done, whether it's an accident where someone is hurt or killed, or um, a lawsuit, uh, a civil lawsuit or whatever. That veil protects that individual, that individual owner. Correct?
Yeah, that is correct. And I will tell you, in 40 years of public accounting, I never had one case of a client that ever was challenged on that. In 40 years of public accounting, I had the IRS raise the issue on one corporate client where they threatened, and I did not do a lot of representation to the IRS, but when I did, I generally would bypass and go straight to appeals
Okay.
because you get answers in appeals. The one case in my career that I had where the auditor raised piercing the corporate veil as an issue, we bypassed the management meeting and went straight to
Uh,
appeals, and appeals kicked it out.
okay. So let's talk about some of the violations. I've had a little bit of experience with those, but let's what types of things do business owners need to know that they need to stay away from, the types of activities that they need to be careful with and need to stay away from in order to maintain the integrity of that corporate veil?
First one's records. If they're not keeping if they're not keeping records at all, they're running the risk of losing the protection of being a corporation. Some people get lucky, make a lot of money, but it's all about them, and they want to raid the corporation. And you know, it you don't see that happen a lot strictly out of natural business cycle. And, if people aren't in for the business for the right reasons, it has a tendency to flush itself out over time and take care of itself. So it's just you have to keep it's a separate entity. It's a creature that you've created. You
Yes.
have to feed, you have to take care of it, you have to maintain it, you have to groom it, and
Well,
you've got to treat it.
let's say a little worser scenario develops, and you have an S corporation, so you have a corporate veil in place, but and I'm doing this just to kind of reinforce. I'm bringing this up to kind of reinforce how things, you have to be careful about certain things. And so the company is moderately profitable. That there's times when it's not. Um, they have a significant debt to vendors, but the owner or one of the members comes in and, we had a big project, and we made $200,000 on that project. I'm going to take that cash. This is kind of a severe scenario, but unfortunately, I think it happened. In fact, I've seen it happen. So, is that something that would cause the veil to collapse? To paying
It
yourself
could.
before you pay your vendors and pay your employees.
Yeah, I mean, because what does that look like? It looks like preferential treatment. Okay. And what's preferential treatment? It's a good way to get debts not discharged in a bankruptcy. Oh, yes, you have to, yeah, you've got to do, and I use this a lot. It's common sense, Brad. It's common sense. I mean, it's just, if something smells, then it's probably doesn't make a lot of sense.
Yes.
So, and because what do you do with things when they start to smell foul? You get rid of them.
Yep. Yep. I just wanted to bring this one point out. I'm Sally, and Sally's kind of taken a turn to the worse as far as her facial features. But I'm a business person. I've been in business for 10 years. You're my CPA, or I don't have, maybe I don't have an appropriate CPA. And I get the letter either from, either from the state or the IRS that they want to conduct an audit. That's just more reinforcement for what the point you've been making during this conversation is, you better be able to produce the records and prove what you've done. Correct?
Absolutely. You're absolutely right. And a lot of my audits that I had clients, when they'd get that letter, of course, they'd freak out and call me up. And of course, I'd chuckle and they'd say, why do you think this is funny? And I said, because I just got a raise.
Yeah.
You're going to have to pay me to represent you. But
Yeah.
you know what? And the people that work for the IRS, they're like you, they're like me. They're nice people, Brett.
Yes. For the most part.
And I would tell my client, I said, hey, your records are in great shape. Give me I'm not, give me the receipts. I'm not sure they're going to go, because the first thing they do when they audit you is they look at your tax return and they go, okay, where is there areas for abuse? Where on this return can you tell me that there's probably deductions that aren't warranted? Well, that's why first thing they look at is automobile, and that's one of the disadvantages of being a proprietorship. One of the big disadvantages of being a proprietorship, Schedule C, just an individual, is about 2% of those high income Schedule Cs get audited every year. Why? Because there's a lot of mom and pop stores that do their own taxes
Yeah.
and do their own Schedule Cs.
They've got
And
TurboTax.
what do you mean I can't have 10 cars written off in the business? I got 8 kids and they all work for the business. So they look at areas for where there's going to be abuse. Most of my audits, I went in and you show the auditor what they want to see, and they'll do a couple of checks, because first question they ask you, they'll say first question on automobiles. Let's look at automobile expense. And the first question always on audits, have you made an allowance for personal use of the vehicle? You say no, they get a smile on their face and they get all fuzzy and they dig in and they go, okay, let's dig deeper.
Unless you can prove that automobile is never used for personal use. which means you have to have a different automobile available for personal use. But yeah,
Exactly.
I've seen that.
And what does that auditor do when they ask the question and you say, yes, I've made an allowance for personal use of the vehicle? 9 times out of 10, they'd say, let's move on. Because then it becomes subjective, or they'd want to see the record. And I'd give them, did my clients ever keep a daily log?
Yeah, exactly.
Even my engineers didn't keep daily logs, and
Yeah.
they're the most people that they are when it comes to record keeping. But if you take the beginning of the year mileage, end of the year mileage, you figure out what you're commuting.
Some of the worst audits, as far as time consuming and just tedious, are sales tax audits, because it is document heavy. They want to see. They're going to come in and they're going to take a statistical sample. You've got X number of transactions through the year, and they're going to take a statistical sample of that and audit that sample, and then spread the results over the entire amount. And it just takes a lot of time. Well, thank you, Tom South. It was a very productive conversation we had today. I really appreciate your participation. If you enjoyed this conversation, please like and subscribe. We'll see you next time.